Tariffs, a slowing economy, and 3% market drop. Has Wall Street hit the panic button, or is this your chance to cash in? Hey everyone, welcome back to the Stock Pro. It's your weekly market update, and buckle up, this week was a wild ride. Stocks tanked, tariffs threw us for a loop, and the economy is showing signs that it might be downshifting. We're diving deep into the numbers, the trends, and what it all means for your money. If you're new here, hit that subscribe button, grab a coffee, and let's break it down. Alright, let's kick things off with how the markets did. Spoiler alert, it wasn't pretty. The S&P 500 dropped 3.1% this week, closing at $5,770. That wipes out its year-to-date gains, now down 1.9% for 2025. The Dow Jones Industrial Average wasn't far behind, shedding 2.4% to land at 42,802. And the Nasdaq down 3.5%, putting it 5.8% in the red for the year. But here's where it gets interesting. Under the surface, we're seeing a big shift. Defensive sectors, think healthcare like Johnson & Johnson, or consumer staples like Procter & Gamble, they're holding up, even leading the pack. Meanwhile, the high flyers, tech giants like Nvidia, Microsoft, and consumer discretionary names like Tesla and Amazon, they're lagging hard. Investors are clearly spooked and playing it safe. Globally, it's a mixed bag. The MSCI EAFE index, which tracks developed markets outside the US, actually popped 3.5% over 4 days ending Thursday. Why? Some investors are hunting for value overseas, European tech, Chinese stocks, while the US takes a breather. We'll circle back on that later. Bonds joined the party too. The 10-year Treasury yield ticked up to 4.3% this week. But that's after a big drop from 4.8% mid-January. Investors are flocking to safety as stocks wobble. And oil down 3.9% to $67.05 a barrel. Tariffs and demand worries are hitting energy hard. So what's behind all of this? The US economy is starting to feel like it's shifting gears downward. Last year ended strong. Q4 2024 GDP growth hit 2.5%. Consumer spending was rocking at 4.2%. But Q1 of 2025, it's a different story. The Atlanta Fed's GDP Now tracker is now forecasting a minus 2.4% annualized growth rate. Yep, negative. What's dragging it down? Two big culprits. First, imports spiked. Companies are stockpiling goods ahead of potential tariffs, which we'll get into soon. That's skewing the numbers, but it's not sustainable. Second, consumption's tanking, down to 0.4% from 4.1%. And since consumer spending is 70% of GDP, that's a massive red flag. Retail sales and personal spending reports this quarter, both weaker than Wall Street expected. Think about it, holiday spending carried us through late 2024. But now folks are tightening their belts. Big retailers like Target and Walmart even slashed their forecasts this week, saying consumers are pulling back. That's a ripple effect you can't ignore. Corporations are feeling the pinch too. Q4 of 2024 was a banger. S&P 500 earnings grew 18% year over year, the best since 2021. But for Q1 2025, forecasts have slid from 11.5% to 7.3%, and Q2 is down to 9.7% from 11.3%. The back half of the year is still holding at 11% for now, but it's clear Wall Street's dialing back expectations early in 2025. Does this mean a recession? Not yet. The economy started 2025 from a strong spot. Above trend growth gives us a buffer, but this slowdown's real and it's got markets on edge. Now let's talk about the big elephant in the room. Policy uncertainties cranking up the heat. This week the administration rolled out 25% tariffs on imports from Mexico and Canada, only to hit pause until April 2nd. You'd think the markets would cheer, right? Nope, they kept sliding. The US trade policy uncertainty index is through the roof, higher than 2019 levels. Why? Canada and the EU are promising retaliations if these tariffs stick. Picture this. Higher prices on everything from cars to groceries. Walmart and Target are already warning about that, saying it'll hit consumers and their bottom lines hard. It's not just North America. The EU is eyeing reciprocal tariffs, and the threat's looming over April like a dark cloud. Companies are rushing to stockpile now, which explains that imports surge. But what happens when that slows? Uncertainty is paralyzing spending and investment. Add government cost-cutting to the mix. February's job report came in at 151,000 jobs added. Decent. Unemployment's just 4.1%, but federal layoffs are coming. And new job growth already cooling. Corporations might hit pause on hiring if tariffs and a slower economy keep dragging. Think about it. Consumers are hesitant. Businesses are rethinking big moves like acquisitions or IPOs. That's why sentiment's souring. Even with that tariff delay, it's not relief, it's just a ticking clock. Big retailers are sounding the alarm too. Target said this week, hey, softer spending's here, and Walmart's bracing for tariff-driven price hikes. That's not just stock, it's hitting forecast and stock prices already. Okay, enough gloom. let's look at the silver linings, because there are some. First up, the Federal Reserve. With the economy cooling, markets are betting on Fed support. At the start of 2025, no rate cuts were priced in. Now, 3/4 point cuts by year end. Fed Chair Jerome Powell spoke last week, saying, "The economy's still decent. Consumer spending's moderating, but we're patient." Translation, no rush to cut rates, unless jobs start tanking. If tariffs don't spike inflation too much, 2 or 3 cuts this year, totally doable. Bonds are stepping up too. The 10-year Treasury yields at 4.3% now, up a bit this week, but way down from 4.8% in January. Investors are piling into safety as stocks wobble, and that's stabilizing things. Bonds could be a portfolio MVP this year. Here's another bright spot. Policy might flip to the good stuff soon. The administration's obsessed with tariffs and layoffs now, but tax cuts and deregulation could take the next stage, maybe after April. Lower corporate taxes, less red tape, markets would love that. It might even dial back the tariff focus if inflation or growth take a hit. And check this out, investors are rotating. Defensive stocks like healthcare and staples are shining, while tech takes a breather. Some are either jumping to international equities, European tech, Chinese growth stocks, chasing value as US growth cools. So yeah, there's hope. The economy's slowing, not crashing, and these shifts could set up for a rebound if the stars align. So what's next? Next week's a big one. CPI inflation data drops, and we get a first read on consumer sentiment. If inflation's hot, expect more market jitters. Tariffs could make that worse. If it's cool though, we might see a bounce, especially with Fed cuts back in play. Here's some perspective. This pullback? Totally normal. Markets see 1 to 3 drops of 5 to 15% every year. After 2 years of 20 plus S&P 500 gains, a breather was due. No recessions on the radar yet, so this could be a chance to buy low. What should you do? Long-term investors, don't panic. Time in the markets beats timing the markets. Use this volatility to rebalance, maybe lean into bonds or defensive stocks, or start a watch list for deals if prices dip more. Chat with a financial advisor if you're unsure. Keep your goals in sight. Let's wrap with the numbers. Dow at 42,802, down 2.4%. S&P 500 at 5,770, down 3.1%. Nasdaq at 18,196, down 3.5%. The MSCI EAFE up 3.5%. A 10-year yield at 4.3%. Oil at 67.05%, down 3.9%. Bonds via the iShares Core US Aggregate ETF at $98.35, off 0.9%. So what is your take? Are you buying the dip or waiting it out? Make sure you're fully caught up and watch last week's analysis on screen right now. Thank you so much for sticking to the end. Hit that subscribe button and I'll see you next week. And as always, happy investing.